latest.
Thank you so much, Romeo, for the responses coming through from our viewers. Keep them coming. Hashtag Morning at 10 TV is where we are. You can also stream us live. We are live on Facebook and YouTube pages. Just head on there and get all the info, just in case you're stepping out, all right? Let's get into a business conversation this morning. And of course, we're getting into matters, pension plans. And of course, with a keen focus on what happens after you retire or what happens after you leave the earth. Yes, unfortunately. And so the Makerere University Retirement Benefit Scheme pretty much has launched an annuity plan for its members to enable them continue getting a regular stream of income through their retirement period. Now, this particular scheme has partnered with the insurance company of East Africa, what we all know as ICEA, to give the university staff who are saving with the scheme an opportunity to invest their benefits in a lump sum, yes, in annuities, such that they continue earning in their retirement. Quite amazing. So what is an annuity plan and what does it entail? So we're going to be having that conversation to just break it down for you so you can get to understand why you need to jump on this bandwagon, so to speak. So in studios, I'm being joined by Mr. Oyuk Francis. He is the Assistant Manager Pensions at ICEA. Thank you so much for making time and welcome to Morning at 10 TV.
Thank you, Mala. Good morning, viewers.
You're welcome. Good morning. Now, let's start with your partnership with MABS. Of course, the Makerere University Retirement Benefit Scheme. Why now? They've been doing amazingly well. We know that when you look at that particular radar and cluster of pension schemes that are doing quite well, we do have NSSF, we do have the Bank of Uganda, we also have the Parliamentary Pension Scheme, and then they come forth. So that actually shows that they're doing amazingly well. Pension schemes are not easy to run, so to speak. So when it comes to your partnership with them, first for you as ICEA, as an institution, why did you see them as an amazing, pretty much company to work hand in hand with? We can start from there.
I think our partnership with MABS, Makerere University Retirement Benefit Scheme, starts from way back. But this is mostly because on top of being one of the largest schemes in the occupational scheme sector, they're one of the best managed. And of course, we've had a relationship for quite some time. Not to say that we've not had one with the other larger schemes. And we're definitely working on partnerships with other larger schemes, especially, for example, Bank of Uganda. We're looking at a partnership with URA, the Uganda Revenue Authority. We're looking at something with UNEP, the Uganda National Examinations Board. We're looking at all these large schemes and basically providing an opportunity for their members to have annuities as an option. So that when the time comes, when you retire, when you receive that lump sum, yeah, you're not tempted to go into, like someone said, you've been a right-handed man, and at old age is when you're trying to look at learning to be left-handed. Yes. So we're basically providing an opportunity to prevent old age poverty, yeah, to continue, or for you to continue to have a secured income in your retirement. It's basically providing income substitution as you go into retirement. And we believe that our partnership with MABS is going to be a good demonstration, a way for us to basically pilot this program with the large organizations. But of course, we have several other clients. We're not only dealing with organizations, we're dealing with the population at large, individual customers. We have quite a number. But we're now trying to look at also strategizing and bringing organizations in place because they are more trusted and they basically, generally, it may look like we generally try to, most of us try to have other people understand for us. Right. And we trust these organizations. So in partnering with them, we're hoping to get through to quite a number of those cases.
All right. So, when we look at retirement, yes, there's two options. There's retirement life after retirement, making sure that you secure yourself. After that, social security is critical. And I think that's where NSSF is doing amazingly well, just to ensure that, hey guys, after that time when you're strong and able to actually get a monthly income, then at least there's something you've saved on the side that will help you after retirement. There's retirement, there's also saving for your beneficiaries or for your family, children, so to speak, yes, after you're gone. Let's look at these two things because we need to educate our viewers today. Let's look at annuity plan, the annuity plan, what it's all about and its differentiator to life insurance, what many know as you're saving not for your benefit, but for the benefit of your beneficiaries or children once you're gone. Let's differentiate those two, but you can hammer in on annuity plans, so to speak, so we can get to understand this as the viewers.
Okay. So the main difference, life insurance generally, okay, annuities are part of life insurance. Yeah, it's long-term business. The difference in this case is when you have a purely risk product, life insurance product, you're looking at your beneficiaries. It's usually not about you.
Not about
It's about the people you leave behind.
Yes.
So we usually say it's of showing love for those that you will leave behind. But annuities is basically, it's more like a pension. It's a pension, yeah, in the way that we know it. It's an opportunity for you to actually benefit from your hard work for all those years that you've been employed. So how this one works in this case, we basically get a lump sum from you, and in exchange for that lump sum that you give us, we give you periodic payments for life. Currently, the way we've structured it, we have it as an immediate annuity or a deferred annuity. An immediate annuity works in a way that we get a lump sum, for example, today, and starting at the end of this month, if you've chosen a monthly option, we pay out basically a payment every month for the rest of your life. Alternatively, you could say maybe I still have an income stream. Maybe I'm employed somewhere, maybe I have a contract somewhere. In that case, you would buy what we call a deferred annuity. And basically, it would give us a lump sum, but in about maybe 2, 3, 5 years, we would start to pay out a lump sum, a periodic payment, maybe monthly, maybe quarterly, maybe annually for life. What we've also done, we've also said, fine, usually we have one breadwinner. How about the spouse? Because you're growing old together. So in that case, we have what we call a single life annuity or a joint life annuity. So in a single life, you're there alone. Yes. So we pay you for life. Alternatively, you could say, I would like to come on board with my spouse. So in that case, we would receive the lump sum and make payment until the last survivor. Basically, we would pay until the last surviving spouse passes.
So it's till death.
Yes, it's still death.
Literally.
We try to avoid the word death because generally people do not want to hear about death.
But it's inevitable.
It's inevitable, yes, it's inevitable. But it's very difficult. It makes it difficult to sell life insurance, generally speaking. Yeah, so also, the other option people are asking is, yes, fine, you're giving me these periodic payments monthly. How about purchasing power? There's inflation.
Right.
Yes, so what we've done, how we've solved that, we've added an escalation. So our policies escalate every year. You could choose that option. We have a 3% and we have a 5% escalation, meaning that every year, those periodic payments we make, meaning at the anniversary of your payments, we just increase your payments by 3% or by 5%.
Let me ask you this, Mr. Oyuk. You're saying that, hey, the annuity plan, and this is for the sake of our viewers, we really need to understand this. I give you a lump sum, for example, X amount of money, and you get to pay me a consistent amount, of course, with that inflation bracket catered in there, 3%.
Yes, or 5.
Yes, or 5%.
Yes.
Every single, well, let's talk about months. You can talk of months, whatever you want, quarterly or once a year as well. We have those people who would want that as well. Now, exactly, there are those options. Now, there's this lump sum every single month. Let's talk of monthly, and you're telling me you're going to give me X amount every single month to that point in time where I'm gone, perhaps. My question to you would be, how do you get to understand, or how do you work out the numbers to make sure that this amount of money I'm giving you as a lump sum sustains that period of you paying out that consistent amount every single month? Do you have a bracket whereby you're saying that you cannot give us anything less than this? How does it work out in terms of numbers? Because I'm looking at it and I'm thinking, wouldn't it get to a point whereby this saving is actually gone and depleted?
Okay, so that's the beauty of an annuity, and one offered by an insurance company. Because as a life assurance company, we are going to get this lump sum, we are going to invest it. We've done all these actuarial computations, and we have put all that into consideration. It's guaranteed income. And that's what I'm saying, it is for life. Of course, definitely, at some point in time, the lump sum that you gave us has run out. But do not think of it as a lump sum. You're not giving us your lump sum to invest and give back to you. You're basically giving this lump sum to us in exchange for a payment for life. Meaning, don't even think about the lump sum anymore, because trust me, we shall definitely pay way more than the lump sum that you gave us. Yes. So basically what happens is we invest this money in assets. We are basically regulated by IRA, the Insurance Regulatory Authority of Uganda. It's a risk product that has been approved. So we've put all those considerations in place, the risks involved. And we are very confident that we can meet those payments, and we have, because for example, in Kenya, where our company is headquartered, we have quite a large annuity book and very many years and basically decades of experience. So the money cannot get finished.
It cannot
yeah.
get finished.
So don't think about it like these are not your savings getting done. This is the company paying you basically periodic payment for the rest of your life.
All right, let's work out some math here for the
Yes.
sake of our viewers. Again, it's a classroom today, and we
Okay.
really want them to get it right. Do you have any threshold with regards to what I can give the insurance company as my lump sum?
No, not really. What we advise, you see, the professionals out there, the experts advise that for your retirement, you need about 60 to 70% of your retirement income.
Okay.
So for example, the salary you're earning at your job at retirement, if you can be able to compute something which is about 60, 70%, that should be comfortable for you. So it really comes down to what is comfortable for you in retirement. If you're comfortable with that figure, we are here to work with you. So basically, we can work from, we have two ways we compute this. You can just give us a lump sum, and we tell you how much we can pay you every month for life. Alternatively, you could come to us and say, maybe I would like to earn 2 million every month for life. So we can work backwards until you for us to achieve that objective, or to help you achieve that objective, we shall need a lump sum of so much. So those are the two ways we actually work it out. But it really depends on you, because it's about your needs. It's not the insurance company imposing this on you, no. It's us partnering with you to ensure social security, to ensure an income, a secure income throughout your retirement.
Right.
Because trust me, I believe, look, I've not retired myself, I'm still a young man, but there are quite a number of people out there who are frustrated in retirement, you know, because it's a big challenge. They have been fleeced with their money.
Right.
The research basically shows sometimes 3-5 years after retirement, very few people can actually trace their lump sums.
Right.
So this is an opportunity to ensure that at least for the remainder of your life, you're assured of an income stream.
Let's look at transparency, because like you said, let's not even do the math. I think you've broken down well enough, working backwards. So I can't tell you I'd like to earn, for example, 5 million every single month. Yes, and then we work backwards. What will that mean? Lifetime. Of course, only God knows for how long we're going to be on this surface of the earth. But working backwards, and you said, okay, 5 million, and then that will inform the lump sum I'll give you.
Okay.
Now, you pointed out to that factor of you investing that money.
Yes.
If this money that you've invested out of the lump sum I gave you actually has 100-fold returns, are you transparent enough to come and tell me, hey, Mala, this is what we have, your monies pretty much have grown, then over and above reviewing it from inflation point, we can actually review the amount we're giving you per month. Then does that happen?
Let's think about it a little differently. There are usually two classes of products sold by insurance companies. They are what we call with-profit products, and they are guaranteed products. Now, if you had a with-profit product, usually you'll share both in the highs and the lows with the insurance company. But most people who are retiring do not want that. Usually when you're getting towards retirement, or when you're past 60, 55, you want something more stable, something more predictable. So we push for guaranteed products. So our annuity plan is guaranteed, which means that no matter what happens, whether there are highs, whether there are lows in the economy, you're guaranteed of an escalation of 5%. Even if the economy performs poorer than that, you're guaranteed of an income for life. So like I said, it's not like you investing and risking your money. No. You're basically just buying a guaranteed product that is guaranteed to escalate every year for life.
Right.
Yes.
All right. So now we understand where the business is.
Yes. But
because the majority would look at it as a huge risk for the insurance companies. But now we do understand that, you know, this one is a guaranteed product.
Yes.
It's not for profit. And so that way, at least we understand during the highs, that's where maybe the insurance would cushion themselves.
Definitely.
Okay. All right.
So one more thing I'd just like to add. On top of that, we also have what we call a guaranteed period, which means that basically how this came about is some people would ask that, what if I buy an annuity plan,
right,
and after maybe 2-3 years, maybe I pass away? What happens to my lump sum?
Yes.
And we are saying that we have options for guarantee of 10 years, 15, and 20, which means that if you bought a guarantee of 20 years, it means no matter what happens to you during the 20 years, we pay these installments up to the 20-year mark.
To your next of
to the
kin.
beneficiaries,
All
yes,
right.
definitely. And lastly, basically to sweeten it up a bit, we do also give you automatic medical insurance enrollment, because as you know, most seniors they're basically excluded from medical insurance.
Right.
But if you're an annuitant, you're entitled to automatic enrollment for medical insurance from ICEA.
How does that work?
Basically, we have packages for the seniors, which is something that is, I think, a first in this market. So our sister company basically provides for us a medical insurance cover. So we allow you to enroll, and for a small premium of your monthly payouts, we basically spread out over a year.
So that is automatically deducted.
It's automatically
from
deducted,
what you pay out
yes.
to me every single month, for example.
Yeah, and you're entitled to annual checkups and some limits on medical cover, basically. Then lastly, we also have a funeral cover benefit, meaning that when that time comes when you will be going on to meet our Lord, we shall provide you a benefit of up to 3 million Uganda shillings. Yeah.
You know, what at least now you come out clearly is that there's a period of guarantee, which it's not just about a lifetime cover. There's a period where we agree that you're going to pay out this sums of money for example, 30 years, 50 years. It has to be guaranteed. That has to be articulated. Is it a must?
No.
Or can we have an unspecified period of time with that X lump sum I've already given you?
Now, there are usually two things. Sometimes can be a bit confusing.
Yes.
We pay this for life.
Yes.
But to you, the annuitant, we pay for life, the monthly installments. But in the event that you pass away before your guarantee period, we continue to pay up to the end of the guarantee period. That's only in the event that you pass away before the end of the guarantee period.
Is the guarantee period negotiable? Do you bring me to the table and tell me in the event that you go to the Lord that this is what your beneficiaries will be entitled to for X amount of years? Is that clear? Yes,
it's very, very clear. It's about options. We provide you with options. We say if you would like, we can give you a guarantee of 10 years, maybe 15, maybe 20. It all depends on you. That's the guarantee period. But otherwise, for you as an annuitant, you're assured of payment for life. Both you and your spouse, if you choose a joint life annuity.
All right.
Yes.
Thank you so much for coming through. At least now we know there are options, guys, to safeguard and secure your retirement. We've all known that it's just NSSF, but you can also do it privately, like you told me.
Yes.
If you're an individual and you'd like to secure such a plan for yourself, then you can actually go to an insurance company and get into that as well. Critical.
Yes.
Thank you so much, Mr. Oyuk Francis, the Assistant Manager Pensions at ICEA. And of course, they're working hand in hand with the Makerere University Retirement Benefit Schemes. So if you're maybe an administrator in any pension scheme, maybe you could consider that option. It's quite sustainable, and it's good for you to make sure that you safeguard the future of the people who are saving with you, the pensioners, so to speak. All right, so we're getting into the other side of the studio. Mr. Romeo Busiku is on standby with so much more for you. Romeo.